when you talked about raising capital, right? Having raised $600 million for a syndicate, how does raising capital for an affordable housing project differ? What do you do when you raise capital as a syndicate? Are you just looking out for people to buy the low-income housing tax credits? Can you educate us a little bit?
Sure. Raising capital, it's about the narrative. Community development it's managing capital through a narrative and managing capital through personalities. And what you're trying to do is bring to light the ways in which community development and real estate in community development has an impactful way to transform a community. When you work in the low-income housing tax credit and you're raising capital, investors are interested in, first, does it get them a return that's reasonable? The second thing is, does the project have an impact in the communities upon which the investors are primarily banks? So where those banks serve communities, can you show them that you're making an impact in the communities that they take deposits in? You could almost argue in the same way insurance companies everybody pays into an insurance plan. You could also argue an insurance premium is paying into something that you're taking out in the future. Your pension funds are an investment in something that you individually in your community, right? You're going to take that out at some point when you retire. So if you remember that capital does flow into communities, whether it's based on the census tract, where you do it based on a bank, where you're domiciled in terms of you and your own pension funds or your 401k, or even your insurance. So it's really understanding who your audience is. In my instance, when I was raising capital, it was predominantly banks. So banks have a CRA, Community Reinvestment Act. They need to do this for regulatory reasons. So I would go out and I would talk to them and say, well, what markets do you have a CRA need in? Where do you want your investments made? And they have cycles of investments. They have cycles. They have to be scoped by their regulators. They're looking for a specific return. They're looking for a narrative of impact. How impactful are those projects? What are they doing to transform those projects? What kind of services are they delivering to the communities? We know that affordable housing has to also address workforce and missing middle and attainable housing. Well, if you're going to go raise capital in that area, you have to be able to understand, what does it mean by workforce housing? What does it mean by attainable housing? If a developer is willing to deed restrict their properties, I don't care if it's a tax credit or subsidized or non-tax credit, non-subsidized, if they're willing to do units that are deed restricted or have sub-public welfare, then the narrative is true. Then the narrative is absolutely 100% transformative. When you do something that says, I'm going to dedicate my capital to a benefit for a long period of time, you've created a narrative. And in that narrative, that's worth selling out in the market for community benefits. How are you selling that narrative? In what way are you selling that narrative? Again, with a return, but it's a return with a narrative.
Okay, this is so good. So how do you define workforce and attainable housing? Okay, welcome to another episode of Affordable Housing and Real Estate Investing. Guys, today I got a guy that really knows his stuff. I cannot think of a better way to introduce this guy, because when I got on the phone with him, and I mean, we literally talked for like an hour just right away, and we chopped it up. We talked about the different products. We talked about different strategies, and he is just such a wealth of information. So I cannot wait for you guys to meet him today. Matthew Haas, welcome to the podcast. How are you doing
Great.
today, man?
It's a wonderful Friday. Great second day in May. Doing really well.
Man, so I know you as like the senior VP, the senior banker at KeyBank, but before you got into this world of affordable housing, man, who were you and how did you even get into this world in the first place?
Well, great question. I think looking back on the path that I've had in my own professional career, it's not been linear. I actually started out as an undergrad thinking I was going to be an architect. Did that for a number of years, worked for the city of New York, worked for a small firm in New York City. It's a great experience, wonderful experience, and decided after I had done some work for the city as an architect, working for the Department of Design and Construction Management at HPD, which is called Housing Preservation Development, that I'd go and get my degree in urban planning. And so I went to Columbia University, which was a great experience. Focused on housing policy, housing as a tool to redevelop cities, and finished that up and then went to work for Skills as a project manager for a very well-respected nonprofit in Williamsburg, Greenpoint, New York. They were started in the 1970s and had been a faith-based organization. They're now known as St. Nick's. And they were doing housing and healthcare for seniors. They were doing healthcare and home care for people living with AIDS. They were doing and had managed HUD 202s for seniors. And so I was hired sort of to work with them in that capacity and also help them redevelop a large hospital complex that the city had shut down, known as Greenpoint Hospital. And I was the senior sort of developer project manager of that specific project. And it was a wonderful, wonderful experience. Boots on the ground, going to community board meetings, working on project performas, working on design, getting capital to these projects that I was working on. And it was a wonderful experience. And then lo and behold, the partner I've been with for 40 years decided she was interested in becoming a physician. And she got a job, started medical school in Chicago. So I decided I had to make a shift in my career. Had some great, you always sort of, it's what you know, but it's also who you know. I had some people that I knew really well in the industry, including some family friends, and a gentleman by the name of John Auschler, who is and had created HRNA. Hamilton, Rabinowitz, and Auschler had given me some advice as I finished my planning degree at Columbia. And it said, it's great that you're an architect and it's wonderful that you're a planner. But until you know how money makes the world go round, it doesn't matter how well you design or how well you plan. And so, that was a great piece of advice, a very good piece of advice. And so when I was looking for opportunities, I found an organization that every state has called the State Housing Finance Agency. Every state has one. And I needed to move to Chicago, and the Illinois Housing Development Authority, which is the equivalent to the Housing Finance Agency for the state, needed somebody to come in and run their housing finance programs and applications for the home program and in alignment with low-income housing tax credits. So it was my opportunity to go work for a state finance agency. I have to remind myself I was privileged enough to first move from New York to Chicago for an opportunity through the people I knew, the networks I had. And I was also privileged enough to take a pay cut to take that opportunity. So I took a $15,000 pay cut, and I realized, again, at the end of the day, I felt that was important. I had not done underwriting. I had been a project manager, I'd been an architect, but I had not done any underwriting. I had not done spreadsheets. I had not worked on a thing. Most nonprofits typically are hiring people to do that, and that's how we operated. I was more the muscle of getting the projects through and getting them approved and submitting applications, but not putting together performas. And that was probably the best transition for me. I went to work for two amazing people, two women, Mary Samrakari and Josie Katsiouris at IDA, or Illinois Housing Development Authority, and spent 2 years just understanding the ecosystem. So going from a city nonprofit now to a state finance agency, learning how a state finance agency allocates and awards, one of the most onerous sources of financing, which is the home program. And at the same time, learning about the low-income housing tax credit program very deeply. And that was very rewarding. It was great. I was traveling all over the state looking at projects because this Illinois Housing Development Authority did projects not just in the counties and cities, but did them all over the state of Illinois. I had that great opportunity, and then did that for a period of time. And because I had already done some exploratory work in sort of the housing finance ecosystem, it just so happened that a subsidiary of the Local Initiative Support Corporation, known as National Equity Fund, was domiciled in Chicago. And I decided that after I'd worked for the Illinois Housing Development Authority for a few years, I'd go work for a syndicator of the low-income housing tax credit. And I went to work for NEF, National Equity Fund. And I went to work for another amazing, it's all about mentors and who you know, another amazing woman, yes. Debbie Burkhart. Debbie Burkhart is at NEF, and she's the stalwart, been there for over 30 years, deeply knows about supportive housing, has been deeply dedicated to supportive and affordable housing. And so I went to work for her. And I got the opportunity to do both supportive housing and at that time, also what was then emerging, which is affordable assisted living, which is senior living with services, and trying to figure out if you could do that with low-income housing tax credits and a 115 waiver. which was a specific waiver that states can get to allocate some of the dollars that come from Medicaid to support housing development. So great experience. Learned tremendous amount about how real estate, cash flow, real estate rent is one side of the equation. But when you get into services and you get into assisted living, it's understanding the business model. Assisted living is about a business. It's about how do you serve your clients through case management, medication management, nursing care, FTEs, very service enriched. So it's a sort of a quasi real estate, but more health related in terms of a business. And it gives you a very keen sense. And then decided at that point, my partner in crime and my wife, Stacy, was in medical school finishing up. She got a residency match at UCLA. So lo and behold, I have to move to California, and I got a job working for Bank of America in the community development side. So here I'm now gone from a state finance agency to a bank, which was another opportunity. So I had these fortuitous moments in my career. It wasn't linear. As I said, I started out wanting to be an architect. Here I am now working at Bank of America in Los Angeles, California, learning about how banking is done and what banks do when they do community development. What are they giving in terms of community development loans? Why are they financing affordable housing? And a lot of it had to do with learning the acronyms that a lot of people know about if you're in this space, which is the Community Reinvestment Act, public welfare, that banks have to have some allocation of their capital given back to the communities upon which they make deposits. And so I was in that particular division of the bank, rolled up through commercial real estate, and it was really driving sort of the production of all forms of affordable housing, but primarily low-income housing tax credits. And then, lo and behold, I knew somebody through all the networks I had, and it would be great to go work for one of the GSEs. So I moved from Bank of America to go work for Fannie Mae in 2006. And I started working for Fannie Mae on upper tier fund investments. So Fannie was making investments with syndicating shops. They were taking their hard-earned revenue and figuring out how to deploy equity to what were known and still exist today, low-income housing tax credit syndicators. And I was based in the West Coast managing West Coast syndicators, allocating Fannie Mae's equity to these funds. So I was learning about upper tier funds, how projects got placed into funds, what you were doing when you were managing a syndicator, what a syndicator relationship was about, managing their annual performance. And that was another great way of learning how the ecosystem of affordable housing works. And then crisis. Life has its own crisis and jobs have their own crisis. There was a downshift in the economy. Everybody remembers the mortgage crisis. Fannie Mae and Freddie Mac got out of low-income housing tax credits. They didn't need it. They were under receivership. They weren't making the money that had to made before. And so I was, lo and behold, let go. I had a great opportunity to sort of take a hiatus, got a nice package to sort of live through a period of time, and then got a job working for a CDFI, which is a community development financial institution. Another peg in this community development space, which is the incipient capital that comes in early on. It's the pre-development money. It's money that developers look for to get properties entitled, to take down properties, to advance properties in the communities upon which they live. So I was working for the Low Income Investment Fund in Los Angeles. I was the deputy director for California. I was working on affordable housing. I was working on charter schools because CDFIs played in that space and still do at this time, and doing some childcare centers because LIF had an arm called childcare. So I was sort of doing community development related activity, predominantly most of it housing, but there were some charter schools and childcare centers, all the things that have a community benefit. And it was great. Wonderful, wonderful thing to do. And then after that period of time, decided it was now great, and I had done that, and go back and work for a California-only syndicator, and had a chance to work for Merit Community Capital, which is a national, state, and local equity fund syndicating member, but they only do California. And at that point, I became the director of investor relations. I was raising capital for Merit to expand their visibility, to expand their footprint statewide. And it was a great period. I was at Merit for 7 years, raised, I think it was close to $600 million for them, got their investment bank pool from, I think they had at the time I joined, they maybe had 8 banks to when I left. I think they had 26 banks who were working with them. And that was a great thing to be able to do. And then decided I'd go try my stint. I'd work for nonprofits, again, or state agencies or housing agencies or GSEs. And I thought, well, I'll go work now for a for-profit. And so I went to work for a for-profit arm of what was then the Michaels organization, known as Riverside Capital. The Michaels organization is a large for-profit, probably one of the largest for-profits based in New Jersey. And now I think they're still in New Jersey, actually, Michaels Development Company. And they did student housing, military housing, affordable housing, but they had an arm that syndicated tax credits. And I went to work for them, known as Riverside Capital. So I was traveling back and forth between California. They were nationwide, traveling back and forth between California and Philadelphia, New Jersey, while I was raising capital for them as a syndicator. And then Berkadia, who is one of the largest and privately held entities that does mortgage financing for both market rate and affordable, took a major stake in Riverside Capital, essentially became part of Berkadia. And I was working for Berkadia for a couple of years, raising capital for them. And then lo and behold, somebody I had known, a wonderful, wonderful woman by the name of Kathy Denangelis, who is the head and team lead in the Western region for KeyBank, had an opening in California to come on as a senior vice president for affordable housing. And I thought this would be a great opportunity to go back with boots on the ground. I'd been working in investor relations for Merit and then Berkadia for over 10 years. And that's really high level fund management, investor relations, but I was not directly dealing with developers of affordable housing. And so I thought, well, this is an opportunity to go back and work in banking. Didn't know if I'd necessarily enjoy banking, but I decided to take the leap back into that space and went to work for a great person I'd known for over 20 years, still a wonderful mentor and leader, Kathy Denangelis. And I've been at KeyBank for the last 4.5 years. And I'm very, very happy I made the decision I made to go back to banking. I think that has a lot to do with two things that you've learned, and I think most people should learn, or at least I've learned over my career, which is it's not just who you know, and it's not just what you know. It's also knowing how good leadership builds great teams and builds the ability for organizations to do the kind of impactful work they need to do. And so I've appreciated the opportunity to work for KeyBank. KeyBank is the second largest affordable housing lender in the country, an investor. And the team and the leadership and the people I work with at KeyBank are phenomenal people, work really hard, really dedicated to the community benefit space of affordable housing, and broadened sort of the way in which I look at this whole space. While I've been at KeyBank, we helped launch this CDFI. I worked with a team of people as well as Kathy Denangelis to launch KeyBank CDFI initiative. I've done other kinds of key initiatives with internal people at KeyBank. So it's just been a great space to be in. So I will end by saying, after all that, you start out thinking you're going to be doing one thing. I thought I was going to be an architect, and I ended in banking, doing community development. But I'm doing something that's got impact, it brings money to communities. It's money with a mission. It's the built environment. So that's me in a nutshell.
Man, I'm going to have my kids rewatch this episode. Don't you worry, Matt, man, because the through line through all of this, like you said, is that you started out studying to be an architect, and then you went through public, the city, nonprofits, and for-profits, syndicators, investment funds, raising capital. I mean, wow. But I really liked how you planted that seed with that advice about, hey, it doesn't matter how good you are at planning, doesn't matter how good your buildings look. If you don't know how to finance it,
it's true. Very true.
That building ain't getting built.
Oh.
So, there's just so many things to unpack from here, Matt. And let me start by just asking a question, maybe just on behalf of our kids, because if they ever wanted to break into affordable housing, right? You having been through so many positions, what advice would you have for our kids on how to learn quickly, how to ramp up really quick and understand everything that's going on so that they can make an impact as fast as possible. What are your thoughts? Like, because you've been through so many technical roles, low income housing tax credits, home funds, that's so hard
Sure.
to learn. How would you recommend them even learn all this stuff in the
Sure.
first place? What are
Sure.
your
I think
thoughts?
it's, the evolution of the way in which you learn has changed, right? There are wonderful resources that people can take the time to learn, right? There's Novogradac, who has trainings that you can do. There's state associations that have podcasts, just like you're doing this right now, Ken. And there are ways you can learn about the ecosystem way differently than when I learned, right? The ability to do things technologically have rapidly changed. The way people learn, the younger generation learns, has rapidly changed. I mean, artificial intelligence is changing a lot of what we do on a daily basis. But what I can tell people is that you find something that you're passionate about, the kernel of something that you're passionate about. I'm passionate about the built environment and how it can transform communities and impact individuals and families. And I've always stayed true to that. So I always try to adapt what I know and who I know and what I'm trying to do through that lens. And as long as you stick to that and learn through that lens, you can pretty much find any opportunity. I think the other piece of advice I would say is you need to, like you're doing, Kent, interview, talk to people, have informational conversations with people about things of interest to them. If I'm having a conversation with somebody and they're sharing with me some interest about commercial real estate or affordable housing, I'm captivated by their knowledge. I'm captivated by what they know. And then what I can do is, in my own way, through my own network, find opportunities for them to talk to other individuals, make connections to those individuals, and you never know, find an opportunity. I think there are two things I would recommend, and I say this to those students where I went to my young alma mater, Cal. I'm sort of helping young immigrant students who are, for the first time, getting an education. Maybe their parents never had an education at college. So I'm having them, it's called NavCal, Navigating Cal. And I sort of sit down and talk to the students about what I think is really important, which is a tool that a lot of people utilize, and it's great to start your career with, which is the social connection professional tool known as LinkedIn. I use it daily. It is a great tool. It does two things. It can connect you to people who are thought leaders in the industry. It can provide you a venue or vehicle to clandestinely look in intersectional spaces, especially in my space of community development and real estate and impactful real estate. And it can provide you an opportunity to find jobs and opportunities. It can also, a lot of people don't recognize this, but I have used LinkedIn as a source to find capital. So again, like I said, money needs to flow into real estate. And in everything you do, capital is really important. So again, like I said at the beginning, it's really using the tools, using the resources, and adapting to those resources that are available to you. So, a younger generation is going to learn community development, real estate entirely differently than the way I did. But again, sticking to your passion, sticking to your commitment, and essentially always finding the right connections. And they don't have to be connections directly related at all times to what you do. They can be peripheral, right? They can be as tangential. I think the other way to say it is, somebody once said it, when I started in this business, when I think back on it, it was community development. Now people call it social impact or impact investing. And the way I look at it is, real estate has innately over the years been a commodification of assets, right? Asset classes. It is trying to sell something in the capital markets, and it's trying to break that down into an easy commodity. I call it REITs, or reducing everything into a tranche. I think if that's a great thing to do in the capital markets, but to really do something impactful, you have to see it. You have to look at it through the lens of that might be the end game. But what you really want to do, if you really want to make an impact, is find out the way to bring about intersectionality and aggregation of impact in tranches. So if I'm building an affordable housing project, is it better to do that if it's a mixed use affordable housing project? Can it have other benefits and beneficial components from an asset class to a community? There's one client that I really like. It's Turner Impact Capital, and they have 3 stools. They do charter schools, they do healthcare centers now, and they do housing. And I say in many communities, those are the 3 things that all communities need. Now, if we could only find a way to always think of real estate through how it makes an impact, not just based on its asset class, we can do a tremendous amount to transform communities.
Wow, man, I can already tell why you're so good at raising capital. I mean, you are so clear, crystal clear on what your mission is, what your passion is, and you're clearly very competent in this industry. And let me kind of bring it up a level, right? When you talked a lot about raising capital, right? Having raised $600 million for a syndicate. How does raising capital for an affordable housing project like differ? So maybe help us break it down. Like, what do you do when you raise capital as a syndicate? Are you just looking out for people to buy the low-income housing tax credits? Can you educate us a little bit on what is that?
Community development is managing a narrative. It's managing capital through a narrative and managing capital through personalities. I always like to say we work in an ecosystem in the community development, affordable housing, community benefits space that has personalities, programs, and capital narratives. And what you're trying to do is bring to light the ways in which community development and real estate in community development has an impactful way to transform a community. So, for example, when you work in the low-income housing tax credit and you're raising capital, investors are interested in, first, does it get them a return that's reasonable? Now, it's not market rate returns because they understand that this is a return that's about a community benefit, right? So it's driving it a little bit lower than you would get if you're doing a market rate return. The second thing is, does the project have an impact in the communities upon which, and the investors are primarily banks. So where those banks serve communities, can you show them that you're making an impact in the communities that they take deposits in? You could almost argue in the same way insurance companies everybody pays into an insurance plan. I pay into an insurance plan, right? So you could also argue an insurance premium is paying into something that you're taking out in the future. Same thing with you make a deposit at a bank, right? Your pension funds are an investment in something that you individually in your community, right? You're going to take that out at some point when you retire. So if you remember that capital does flow into communities, whether it's based on the census tract, where you do it based on a bank, where you're domiciled in terms of you and your own, pension funds or your 401k, or even your insurance. So it's really understanding who your audience is. So in my instance, when I was raising capital, it was predominantly banks, right? So banks have a CRA, Community Reinvestment Act. They need to do this for regulatory reasons. So I would go out and I would talk to them and say, well, what markets do you have a CRA need in? Where do you want your investments made? And they have cycles of investments. They have cycles they have to be scoped by their regulators. They're looking for a specific return. They're looking for a narrative of impact. How impactful are those projects? What are they doing to transform those projects? What kind of services are they delivering to the communities? I think even to a point now where it's, broader, like we know that affordable housing has to also address, and this is the nuance, it has to address workforce and missing middle and attainable housing. And I think part of the ecosystem is starting to figure out how to address that. Well, if you're going to go raise capital in that area, you have to be able to understand, what does it mean by workforce housing? What does it mean by attainable housing? And a lot of people this is what's fascinating. A lot of people use those words and don't necessarily have a very good sense of what those mean and what they are in terms of the impact of a community. So they might throw out that in a prospectus, or sometimes they get offerings that say, oh, I'm going to do an affordable housing project. When you dig a little deeper, you realize they don't really have a good sense of what it is they're trying to do. And I think back to the narrative, this is where the rubber meets the road. If a developer is willing to deed restrict their properties, I don't care if it's a tax credit or subsidized or non-tax credit, non-subsidized, if they're willing to do units that are deed restricted or have sub-public welfare, then the narrative is true. Then the narrative is absolutely 100% transformative. It has a narrative that can be attached to making an impact. Some people will argue, well, market rate housing is making an impact. That's true, but it's not as committed in the same way to community benefit, right? It's not as committed to the community. It can be fleeting. It can be extractive. But when you do something that says, I'm going to dedicate my capital to a benefit for a long period of time, you've created a narrative. And in that narrative, that's worth selling out in the market for community benefit. So back to raising capital. It's about the narrative. How are you selling that narrative? In what way are you selling that narrative? Again, with a return, but it's a return with a narrative.
Okay, this is so good. So let me ask 2 questions. One, how do you define workforce and attainable housing? Because I really wish someone would explain that one to me, because people do throw that around all the time.
So people are starting to use the word big A and small a. Big A affordable is the low-income housing tax credit projects. It's the projects with project-based Section 8, with what we call Section 8 contract rents. It's highly subsidized. Those are the big A projects. And, that's a pretty well-heeled and pretty well-done sort of ecosystem that exists in every state, in every county, in every city. And there's subtle nuances. Every year you'll pass a bond, some program will come about, some governor, some county commissioner will pass a new program and dedicate more dollars, but it's all still around that same space. And that's been there for a long time. So philanthropic money will provide that, especially around homeless housing, right? So there's been a lot of focus in the last, I would say, pre-pandemic in that whole space, and during the pandemic. But coming out of the pandemic, people started, and maybe a little bit before that, talking about workforce, right? So what I would say is there's a huge industry that understands the ecosystem of supportive, deeply skewed 30, 40, 50% area median income housing, and sometimes 60, you could argue, right? So that's big A affordable. Small A affordable is anything that's above 60%, going up to 120 or 150 AMI, okay? And again, that's where I see the attainable space. It's attainable, and let me caveat this by saying mostly attainable rental housing, right? There is also attainable for sale housing that has its own ecosystem. It's got its own players. It's got its own way of doing both the capital to build that attainable for sale and sell that attainable for sale. But I do not, and have not played in that space in a number of years. So when I talk about attainable, it's really rental housing that's attainable. So I'd say it's from 60 to 120, maybe 150. And when I say that, I'm throwing out percentages, it's AMI. So are the rents being targeted between 60 and 150% of AMI in that market? What a family of 4, a family of 3, this is done by the unit count and the number of bedrooms in the unit. And that's what attainable is. So it's always, as the way I like to say it, it's not market. It's not market is anything. You can go be anything. It'd be 200% AMI, 250% AMI, and market rate is not the same thing as attainable. So that's the difference, I think, is how you're targeting it, and in what way are you making those units available to people who cannot afford market rate housing.
Yeah, and I loved how you define the deed restriction as a level of commitment. I really, really enjoyed your definition there. And let's talk about, and this question is really because sometimes people get into affordable housing and they don't know what they're getting into, right? They might have the right intent, Matt, but they get a little scared because they're like, I don't know what I'm talking about. I don't know what the CRA is. So pull back the curtain a little bit, right, Matt? For when you were raising capital, right, selling off the low-income housing tax credits to generate equity, what kind of challenging questions did you get? I get that you want to focus on a narrative, but do you get difficult questions? Because I just want to show people how you handle difficult questions so that it's not the big scary Godzilla bank that's
Sure.
gonna scare away
Sure.
developers. Because I think it's possible, especially when you have someone like Matt in the room
Sure.
teaching you.
Yeah, you always get difficult questions. I think the important, again, takes years, and when you're younger, what I would say, ask difficult questions. You get difficult questions. You may not know the answer, and that's okay. Just admit you don't know the answer, and you can say, "I can get back to you, and I'll have to answer. I'll have to figure out what it is you're trying to achieve." Somebody might say, "I want to have you put together a portfolio spread of your current fund and tell me how many units you're targeting that are dealing with supportive housing and homelessness. How do you know the percentage?" I may not know the percentage, but I'm going to have to go back and scrub my portfolio. I'm going to have to scrub the assets that we currently have under management, give somebody the narrative, and come back to them and say, "Okay, this is the amount of units that we've managed that are supportive housing for the homeless. This is how well these units have been maintained. This is how long they've been maintained," right? So you may not know the answer right off the bat. You may have been asked a question. So it's important to say, "Well, I'll have to get back to you," or "Why don't you send me the 4 questions you're asking me and I'll get back to you." In some instances, you may not ever be able to provide the answer to the question. I'll have people call me up, and I learned this really early on. I might have somebody call me up and say, "I'm trying to do X, Y, and Z." And I'll say, "I think I can help you with X, and I think I can help you with Y here at the bank where I'm at. But I can't help you with Z, and the project won't work without Z." But what you can do is, if you have a really good repository of information and a good network, I can refer people to somebody who could do the X, the Y, and the Z. And in doing the referral, right, this is about providing guidance, being a trusted advisor, and helping organizations develop the projects that they want to make an impact in the community. I might not be able to do it at KeyBank. I can try. But what I want to be able to do is provide them an outlet to somebody who might, if KeyBank can't do it. And the reason why you want to do that more than anything, Kent, is that organization, the next time they have a project, they'll come back to you again. And that project actually might work for you then. So it's really important that you don't say no when somebody asks you, "I don't have an answer," or "No, I can't do that for you." What you say is, "I can't do that for you, but here's somebody, or here's an organization I know who could do this for you, or who might be interested in helping you get to the success of what you want to achieve." And as your trusted advisor, because I always think of that as in the thought leader, that's what I want to be able to do. And that was I remember Carol, there was a woman in Bank of America, and she was the head of commercial real estate for Bank of America. And I was working on a project with her, and I went into her office and I was like, "God, this is a really hard and challenging project. I don't know what to do about it." She said, "Well, Matt, maybe you don't need to do anything about it, but what you shouldn't do is just go back and say no. What you need to do is find somebody who could help that organization do what they need to do."
Yes, man. I know I'm gonna make my 3-year-old daughter watch that when she's a little older. But I mean, that's just a great principle to carry forward. I mean, don't just say no. Help
Correct.
them out, and don't help them out with the expectation like they're gonna owe you one. Right?
No.
There's a law of reciprocity. Chances are they might come back to you and they value what you did, and that's how you know that's a relationship
Correct.
you want. But you still helped probably hundreds of families by guiding that person, that
Correct.
developer, to finding the right solution so that they can make the impact that you're in this industry in the first place. That's what you're seeking. So that is just so good, man. And I got to ask this now, because we just talked a little bit about how to raise capital, how to handle some hard questions. So now everybody can feel that, hey, it's possible. But now they might be thinking, okay, well, I got someone experienced as Matt. I mean, what works nowadays, Matt? Like, how do you come up with the right structure? I mean, people just learn how to raise $600 million from you. So now what's the What's the right approach? What's the right structure? What are your thoughts? What are you seeing out in the
Well,
market?
there's this book I want to suggest everybody get it, and I'm not necessarily somebody who likes to plug, but I think before I got this book, I'll say this again. My champion guide and the woman who I very deeply respect, my current team lead, Kathy Denangelis, said, we just have to stop enough and realize we are all unlimited and there is abundance in what we can do, right? So there's this book that I'm now reading. It's by Ezra Klein. It's called Abundance. Okay. And what I can tell you is this work isn't easy. And in some ways, I would say it shouldn't necessarily be easy. You should always be in a space of, again, I'm privileged enough to have worked long enough to have this existential question is, well, what am I doing? And why am I doing it? And how can I be of benefit? And how can I be of service? Right? And I know abundantly how things can come to fruition if people slow down enough, again, slow down capital enough, slow down their own thinking enough, and slow down the opportunity to engage with the idea and the mindset that there is abundance and unlimitedness in the world. It's just a matter of finding the right pathways. Now, that doesn't mean that you don't get frustrated. It doesn't mean you don't get stuck. But take time in understanding that first. If you take solace in understanding that first, it's not easy. It's community development, affordable housing, impact, attainable. It's all hard. It's all difficult. It's all challenging. And it's all challenging, especially right now. Right? We're living in an existential moment. And this is the moment. This is really the moment. I so appreciate you asking, and I'm privileged for you to be asking me to be in this podcast, because this is the moment we all should come together, find solutions, or if we can't find solutions, find others who can find those solutions. And capital is really important to find right now. Very strategically important to find. I would say that's both for new construction and preserving the existing assets that are already out there, right? So again, that's the way I look at it is slow down enough, figure out what you want to achieve, find pathways to bring about the change of abundant and unlimited potential. And even if I can't do it at KeyBank, that doesn't mean somebody else out there can't assist in doing it for you, making you achieve that project.
Oh, that's so good. That's so good. Because I really believe in collaboration, man. I mean, when enough people come together with great intentions that guides or is supplemented by their competency, that's how you come to great solutions. And it's just like when people are willing to contribute a little bit, like everybody pitches in. When you have a big project, everybody pitches in a little bit, and then it makes it achievable, makes it attainable. So I love your thought process of abundance, right? There's enough for everybody. There really is. So there's no need to cut people out of deals or blah, blah, blah. When in reality, when we come together, it creates the best partnerships. And those are the relationships you want for the rest of your life anyways. So, I mean, you and I have briefly touched upon, hey, how does a nonprofit or for-profit company partner together? How does a nonprofit developer partner with the city to maybe the city subsidize it with bonds or with contribution of land? Are you seeing some of those structures, those types of partnerships right now in the industry? Tell us a little bit more about what structures are you seeing that you might recommend folks to kind of go down a path of chasing?
Well, I was at a conference today. You always hear people say things, and listening is part of this whole space. Slowing down enough, listening. I think, what is it? I always say, I have a tattoo on my arm actually. It says silent and listen. They're both words. They both have the same letters. And it's important that we sometimes just be silent and we listen to what people are looking for and what they need. And I think what's really, really important is if you slow down enough, you can find mutual beneficial ways to collaborate. And I think what happens sometimes is people who look to joint venture are thinking about it as being extractive and not additive. And when you come to a joint venture relationship, you're not necessarily going to agree on everything, but you should have a mutual beneficial reciprocity. I'm going to give a little if you give a little, because if we both give a little, we can get more out of it, right? And so I think it's really important, especially in the space of what I call P3, public-private partnership, that everybody's asking that question of themselves. If that's a for-profit and they say they're going to do some mission-driven, impactful, like I said before, narrative, affordable or attainable housing, well, they're going to have to give a little to get, right?
Yes.
And in that conversation, that's so true too if the for-profit is joint venturing with a nonprofit. Now, in our space, you know this more than anything, which is nonprofits are a very important part of the ecosystem. Number one, they do not have shareholders, right? The money goes back to the nonprofit for the benefit of the mission, right? Now, I suppose you could argue that a B corporation says they're trying to do the same thing, and there are B corporations who do the same thing. But, when you think about it, a nonprofit has dedicated board members. They're bringing capital into communities, at least in the space I'm in, and they do not take a distribution of shares. You do not pay shareholders. There are no shareholders. The community owns, or the board and the dedication of their mission. So in the space of community development, big A or small A affordable, you can use and partner with a nonprofit to create the public welfare side. That in some ways, many states, counties, and municipalities have a welfare tax exemption for real estate if you can prove that you're bringing the benefit of affordable housing to a community and you're developing affordable housing for a community that has a public welfare. So in that give, in the nonprofit joint venturing with you, right? You're getting their benefit, their status as being a 501c3 for the public welfare. Well, that for-profit company probably is going to have to give a little bit on their developer fee or something on their cash flow or something in terms of the way in which that project can make an impactful benefit in a community. You're going to ask that nonprofit to help change the narrative, to bring about that yes in my backyard narrative. Well, if you want that kind of mutual reciprocity, we all should be getting a little bit of the share together. Just because I'm a nonprofit doesn't mean I'm going to do it for free, because a nonprofit should always be in the black, not in the red and losing money. So just like a for-profit, double bottom lines are important for nonprofits.
That's right. No margin.
Exactly.
There's no mission.
Exactly. No margin, no mission. Exactly. You can't do what you do if you don't make some money.
And I want to make sure I highlighted that piece, right? You talked about the welfare tax exemption, and I want to make sure the audience understood and caught that, right? Are you referring to getting property tax
Correct.
exemptions?
Yeah, it's a payment in lieu of taxes, welfare property tax exemption. And at the end of the day, the biggest thing, and I learned this way back in the day, there was a gentleman by the name of Joel Rubenthal who worked for community economics. He said, it's great that people get the low-income housing tax credits. Sure, that's a taxed advantage equity for the return. You don't pay, if you buy tax credits, you don't pay federal taxes. Now, if you buy housing estate credits, you don't pay state taxes. So there are two vehicles, right? You're buying those credits in exchange for not having to pay taxes at the state or federal level for a specific amount of time. But if you have real estate tax exemptions and you have it for a 55 years, so let's take, for example, in California, if you're doing a big A affordable deal with tax credits, you have a 55-year land use restriction agreement. It's there for 55 years. You can't get it but for 55 years because you won't get the award. Well, in that same vein, if you're going to do a low-income housing tax credit in California, every single one of those has a nonprofit managing general member. That's how almost, I think, I've never heard of anybody but doing it with a nonprofit managing general member. And the reason being is getting real estate tax wiped out is huge. It's bigger in many instances than getting the low-income housing tax credits for an annual basis. It's huge.
And I got to make sure people really understand this, right? Because when you take out debt, right, you have to make sure that your net operating income has to be able to service the underlying debt. Otherwise, you won't get approved, right? They're not going to give you money if you can't pay down the loan you took out. And so I really want people to understand there are so many levers that you can pull to make your project financially feasible so that you can cover whatever service you want to provide a great experience for the residents and the community while you're able to service the debt because you have financial obligations, responsibilities to take care of the people that believed in your project in the first place. They're not just buying tax credits, they are
Right.
investors in your project, and you have to take that
Correct.
seriously. So that's a great lever that we talked about, Matt. Are there any other levers that you have seen that people have been able to pull to make a project?
Make a project
What else have you
pencil. I'm
seen?
trying to think of in the current ecosystem, are there other ways? Yeah, I mean, there's a new vehicle that's come out recently, and I don't know enough about it, but I've heard that it's available. It's taking a leasehold interest. Safehold is a big new vehicle that people are talking about, which is essentially you can sell your underlying real estate and transform it from fee simple owned real estate to a lease interest real estate. So you can lease it back, and Safehold, who essentially partners with, so essentially monetizing that leased income stream, will give you capital on a fee simple interest piece of property in exchange for having a leasehold interest. And they get a portion of your cash flow, a portion of the distributions. And that's another sort of vehicle to be able to do that. I think when you're thinking about, real estate in general, right, the largest and hardest part is the land. I mean, okay, yes, maybe the real estate too, but the land in many markets is the most expensive thing you can think about. And there are partners out there who, I mean, it's been talked about here in California. I mean, there are diminishing, people of who, what we would go, in the past to churches, right? There's your oh my God, what do they call it? Your people who attend churches and temples. They're, your not constituents, because that's not what it is. That's in politics. But you know what I mean. The people who attend church, that's been diminishing. So churches are now literally having to figure out ways to sort of drive and continue to do the work they do, or temples, right? One of the things they have, a lot of these churches, is land available to them. Well, they can, in certain instances, figure out how to potentially contribute that land at a reasonable cost, or for that matter, lease it for 99 years for a very small amount, maybe some portion of the cash flow, which would help a project get lifted off the ground if somebody's trying to figure out how to develop affordable housing in a particular community. I think other vehicles that are really interesting and I think are probably not necessarily looked at as frequently is that a lot of universities, community college districts, state institutions who actually are their own JPA, Joint Power Authority, even housing authorities, but one of the things I always like to say is there are other entities who play in what are impactful spaces of real estate, right? Universities, colleges, state institutions that teach trade schools, right? They have people who are coming trying to learn. I mean, people who are children, young adults trying to learn. They actually have an opportunity to also play in this community development affordable housing space. Right? They could actually develop some of their properties. They do it for student housing. Why couldn't they do it also for affordable housing for staff and administration and people who are supporting the organization, people who are the ancillary organizations? And, even if you think about it, if I'm an associate professor, I'm not a full-time professor on tenure, they're an employee. They might not be able to afford housing out in the community. Well, if I built attainable housing, well, then my associate professors could get housing. They're not students necessarily, but then I could provide housing for that. Same thing with hospital systems. Large healthcare networks have an opportunity to really sort of slow down enough to say, healthcare or education, the two bastions of centers of communities are how good is your schools and the school support system and the teachers and the benefits that you're getting for your children to get educated, and how good is the healthcare, right, in your community through your healthcare institutions, your healthcare networks, your hospital networks. Those are two bastions of community. They can't survive. A community can't survive without of those. Well, they can be great partners. They have land, they have capital. So I think of, other tangential. That's why I say it's important you find intersectionalities between real estate and other players in the market. There's a great organization right now. I mean, it's it's just fascinating how things are sort of, if they slow down enough, you can start seeing the intersectional spaces. There's Thrive Living in LA is now partnering with Costco to build housing above a Costco center, right? I mean, I very rarely have seen, maybe you see a Target, or maybe you see a Whole Foods, or maybe you see what was the other one? Oh, a Trader Joe's with housing above. But I don't think I've ever seen a Costco with housing above. And this is a Costco which is trying to do attainable housing, which I think is great.
So smart. So smart.
Totally smart.
I mean, my daughter loves going to my daughter loves going to Costco. So I would want to live on top of Costco.
Well, the best part about that is you don't have to buy all that toilet paper and all that thing all the time. You just go down and divvy it up with the people who live above you. Okay, we could buy a Costco card for the whole floor, right? And everybody could split up their toilet paper. Everybody could split up their paper towels, right? Co-living. Think of this: if you could do co-living above a Costco, wow,
that would ruin their business model. Just kidding.
Right.
But this is so good because I want people to really understand. We just talked about so many levers, right? And I really want people to understand that, like, this is like $1 billion skill. If you learn how to structure these deals correctly, I mean, Matt just told you, right? If you can approach a church with the right intent, obviously, to say, hey, if you contribute your land, there's a couple of ways we can do this. Maybe we take your parking lot. Maybe we build some affordable housing there. Maybe you can share in either a ground lease revenue. Maybe you share in a developer fee. Maybe you share in a rent. But now all of a sudden, the church or the religious or faith-based organization, they're able to generate revenue for their own cause, their own mission. Wow, it's a win-win situation for both. Similar if you were going to the universities and the healthcare system, when you are able to help them lower the turnover costs by keeping people on site or have a little stickier effect to them as employers, now all of a sudden, now you're creating a win-win on top of sharing in the developer fee and the rental revenue. There are just so many ways to go about this. And I'm so glad you brought all these opportunities and all these different options up, because the problem with affordable housing is sometimes when people have these ideas, they keep it all to themselves, Matt. And you have just been such a great example. I mean, your wisdom is so good, man. I mean, I'm so grateful you came on today and shared your decades of experience. I mean, this is so valuable. And I know somebody is going to take this information, this podcast. Either they're going to reach out to you looking for money, or they're going to figure out how to structure a deal that's going to create hundreds, if not thousands of units and help thousands of families. So, Matt, I know I want to be respectful of your time, but I got one question that I ask every guest on the podcast, and I love to kind of hear your perspective on it. Genesis behind this question is because, hey, everybody has always told me that you cannot solve for affordable housing. And I don't agree with it. I think it's just a matter of time before great people come together and we get another piece of the puzzle. And eventually we get all the pieces. And I view you as just an important piece to that puzzle today, Matt, just with what you shared. So, Matt, why do you think affordable housing, particularly the lack of a supply of affordable housing, has just been so hard to solve for?
I think it comes down to who you're sort of in front of and who you're talking to about the affordable housing project and the affordable housing development, right? I think for a fairly long time, when I use the word affordable housing, it still has that nomenclature. It's the same thing when you say modular housing. Affordable housing, people still have the nomenclature, oh, it's Section 8 and it's public benefit projects. And that, unfortunately, it's the othering. It's that those people are going to be moving in. You're building affordable housing, right? So that becomes synonymous with public housing. Oh, I don't know how many people say, oh, I'm involved in affordable housing, will say, oh, so you finance public housing. I'm like, no. Affordable, or this is why I say affordable or attainable, big A, small a. It's all important. It's all very critical and strategically important to be able to use the words well and describe them very fully, right? So when you're engaging with communities, you're sharing a narrative with that community about what it is you're trying to achieve. And I think sometimes the mistake is that in some instances, what's going on is you might be talking to your local councilman, and you might be talking to one community organization, and you might be talking to one some members of the community, you really have to take some time to scope out all the sort of facets of what you're wanting to achieve in a community. And you need to figure out what they want and what they need and what they want to achieve from an attainable, affordable housing perspective. I think what happens is developers will come in and just buy right. It's sort of like this whole thing, which is very interesting. I love the mayor's initiative. It's an ED1, like everything is going to get entitled. It's 80% AMI and above, 80% AMI and below automatically as an ED1 development gets in. That's great. You've entitled all these projects, but have those projects been vetted yet with those communities? Do they really, yes, they're affordable housing. Yes, they are hopefully going to all get built, but you haven't really vetted them. You've just gotten them entitled. So I think at the end of the day, the reason why sometimes there's challenges in affordable housing is we haven't slowed down enough. We haven't gone to communities and asked them what they want. We haven't really figured out how to speak the narrative in a clear way. And when you do that, you have a tendency to get what we call not in my backyard, NIMBYism pushback. It's funny you asked this question. Recently, somebody, I so appreciate the state trying to pass all these bills that are for affordable housing to get streamlined, affordable housing to get red tape removed. But I wonder whether or not the state doesn't see that they're actually creating, by not saying all forms of housing should be streamlined, attainable housing should be streamlined. If you only say affordable housing, you're constantly reiterating the same message over and over again. But are you really addressing the broad need for all forms of housing at all income levels? And if you always filter everything through affordable housing, then you're getting really stuck in that space and that narrative. If you don't broaden the narrative and you don't broaden the conversation, I don't know if that makes any sense in what I'm saying. I think it's really important that we again, back to this problem of why affordable housing is so hard. I think it's hard to find land to get entitled. It's hard to find capital to develop affordable housing. It's hard to find communities who don't see affordable housing as public housing. And you need to figure out a different way to change the narrative and a different way to be inclusive of the community.
Man, we never had such a thoughtful response to that. And I really loved how you kind of broke it down between changing the narrative, but also supplementing with just thinking and slowing down. Because I think people are going to listen to this and they're really going to figure out, okay, all the problems that Matt just talked about, changing the narrative. Okay, how do you speak about it, right? And this is why we're on this podcast today, debunking the myths of what's really affordable, what's attainable, what's worth, and then just shining a light on a policy that's coming down the road. Hey, policy is never going to make everybody 100% happy. It's just not possible. So how else can you go about it? And you need to invite the conversation before you can even make a decision. And involvement community, that's probably the number one through line that I've seen throughout all this. Obviously, right, capital, but getting community support, that's so important, because you don't want to leave a bad taste in someone's mouth, because then you're just going to create opposition, more polarization, and that's not going to help. So Matt, hey man, I am so grateful you came onto the podcast again today, man.
Well, thank you, Brad.
Seriously, without people like you, I would never have the home I grew up in. So for that, I'm just so grateful for all the work you have done throughout your career, and more importantly, for you being willing to come on today and sharing your knowledge, because this stuff was closed off to so many people, and you came on today and you pulled back the curtains and you made people feel like it was possible.
Well, thank you so much. So I'm privileged to have you to ask me to be part of this podcast. And again, always available to move the dial and help build all forms of housing so that people can find a sanctuary and a place of safety for every single family member and for every member of a community. Can't thrive without housing. Housing is health. Jobs go home to sleep at night. I like all these expressions, right?
Well, Matt, I hope people don't blow up your DMs on LinkedIn too much, but where can they find out more about you, what you do, and follow you?
You can find me on LinkedIn. You can connect with me on LinkedIn. That's one way. Another way is you can always reach out to me at KeyBank. It's Matthew with 2 T's _A_ Haas, that's Haas at KeyBank.com. And then my phone number for work is 818-433-2701. And I'm more than happy, I find time, to spend 10, 15 minutes providing my, connections and my insights.
All right, guys, go easy on his phone number, please. Please go easy on his phone number. Well, Matt, what kind of projects should people bring to you? Do you typically only work on projects of a certain size? Do they have to be affordable? Have to be workforce? What does that look like?
Again, bigger sizes is, I can do a, $100 million deal or a $50 million deal or a $10 million deal. I all have to spend the same amount of time. The bigger, the better, but that doesn't mean that I'm not only going to look at bigger deals. I think it really comes down to, do they, pencil? Are they a pencible deal? Does it work on the back of the envelope? Do they, can they support debt? Do they operate well? Does the developer, I always say there's things, character, credit, and capacity. So one is the character. Are the players who are the team developers, are they dedicated and committed and fashioned to the idea of attainable or affordable housing, right? And I say that, I learned this early on. It's a great way of thinking about it. Tourist developers are great. They can do great stuff. But a tourist developer isn't dedicated to a community, right? So somebody who's a warehouser developer or a tourist developer, a little bit leery of that because they're not committed to a community. Doesn't mean that in 5 years or 10 years you couldn't sell your portfolio. But if somebody comes in and they're a tourist developer or fly-by-night developer, we call turnkey, that's a little hard to sell because I wouldn't say they're necessarily committed to a community. So one is the capacity and character of the thing. The next thing is the credit. Do they understand and have they scoped out what it is they're trying to bring to me or anybody who's doing community development? Do they understand what process they think they can achieve? I cannot tell you the number of times I will have somebody come to me and say, I'm doing a Section 8 deal. Do you know what Section 8 is? Do you understand the difference between project-based Section 8 and tenant-based Section 8? You better know the difference between both of those. It's really important because they are totally different when they're looking at from a financing perspective, right? So everybody, sometimes you have to slow down enough, call people. There are so many resources out there. If you're thinking about a particular subsidy type or a particular product type or a particular program type, call around. Understand the players who already do this. There's so many other players who already understand this business and understand it well. So again, it's the credit. Do you understand the credit? Do you understand that product? Do you understand what you're proposing to do? And then the last question is the capacity. Do you have the right people? And do you currently have a real estate portfolio that shows that you have the capacity over a long period of time, for however long you're building the project and renting the project and maintaining that project, to continue to manage that asset, to serve that particular client or those particular tenants under that particular program? So do you have that capacity? Those are the things that essentially I'm looking for. And I think that most people in community development are looking for when they want to look at a deal.
Man, and what a piece of golden nugget to leave the audience with, because now you know how to pre-qualify yourself before blowing up Matt's DMs or his phone number. But I think, no, seriously, I think that's a great little nugget because now you can understand, hey, what do I need to have all together, for lack of better words, before I approach a bank, a financial institution with questions? And these are very
again, I'm more than happy. I'm also more than happy to take the questions. What I want is the ability of somebody to not just throw it out, but come to me and say, hey, this is the problem I'm trying to solve, and I've run into this particular issue. Is there some way you can help me figure out how to solve it? I'm more than happy to do that.
And that's why I'm just so grateful to be on the podcast today, man. Man, this has been so fun, man. I cannot wait to have you back on the podcast. We can dive deeper about what does even making a deal pencil even mean? Because that could be a 1 hour.
Oh, yes. Oh, absolutely. Itself, how do you meet that coverage ratio? How do you do OpEx? What are the stressors around OpEx? What's a cap rate? All that.
All right, Matt. Hey, this has been fun. I'm going to run, but I We'll see you
Absolutely.
soon, man.
All my
Thank you so
best
much
to
for
you
coming
and
on
your
again.
family. Be well, stay healthy, and be safe.
I
Appreciate you
Have a
too.
good one, man. And
Bye.
we are out.